Hello everyone, in this video we're going to be walking through the workbook exercises for chapter 1, and in chapter 1 we're going to be working on the problems AP 8B, AP 14B, and AP 15B. So with that said, let's get started in here. So for AP 8B, we've got some information provided here. This is a direct screenshot basically from the workbook, and we're going to complete the problems, and you'll see this throughout the semester. I know this is our first time walking through the workbook exercises, but I've created essentially an Excel template here that we can work in to complete the problem, and I will show you some Excel tips and tricks and things of that nature so you can follow along and learn some Excel skills while we are completing the homework, workbook exercises, I should say. In addition to learning the foundational accounting skills, I hope in this class that you can walk away with some Excel skills and just having the experience in Excel, completing the homework workbook exercises this way. Okay, so for AP 8B, we have this individual, and in this chapter, a reminder, we're looking at personal financial information essentially. And so here we have Alan Marshall preparing a balance sheet and income statement for the month ended July 31st, 2018. And we've got some financial accounting information provided here for beginning balances or opening balances at the start of the month. And so you can see here, Alan Marshall has a cash balance of $4,400. His assets here, remember, so assets, the things that he owns, cash, the contents of his home, automobile, his house, and those are all of his assets. And so you can see over here under the, I should highlight here, the assets section, all of these, we have cash, contents of home, automobile, and house. And then on the liabilities side, he has unpaid accounts. So we've got $8,500. And then we've got a mortgage, so a loan that he took out to purchase the house, basically. And so here we've got our liabilities. And then finally, we have net worth. And if you remember our accounting equation that we've discussed, the foundational accounting equation says that your assets must equal your liabilities plus net worth. And so that's what we're going to work through. And this is, again, as I mentioned, our starting balances. So these are his opening balances at the beginning of the month. And then during the month of July, we have a whole breakdown of different transactions that happened. And we are going to account for those in our spreadsheet here. And as it notes here, we're going to record our opening balances in the T accounts, which is what these are here. These kind of, you can see sort of the T shape, crosswise and down. And then we will record, so for step 1, we're going to record the opening balances. Step 2, we're going to record all these transactions. And then we're going to complete the calculations. And down here we have a place to check and make sure after we complete all our calculations that indeed our assets equal our liabilities plus net worth. And that will give us some confirmation that we have remained in balance, essentially, as we've done our work, which is an important foundational requirement for accurate accounting. Okay, so step 1, as I mentioned, let's start by recording our opening balances in the T accounts. So really, we're just going to come in here and we're going to take these balances and input those into the spots where it says opening. And I want to highlight one thing for you all, and this is an important concept to kind of start to familiarize yourself with. When we're talking about increases and decreases and which side of the T account those are going to be on, and we'll see some of that as we work through, note that those are different depending on whether we're talking about assets or liabilities. So like you can see here, for an asset, we're going to have an increase. We would put an increase on the left side, and we would put a decrease to an asset like cash on the right side. But for liabilities, it's the opposite, where we would put a decrease on the left side and an increase on the right side. And that's kind of driven by this accounting equation idea. If you want to try to understand the theory behind it, the assets, as I mentioned, the accounting equation says assets equal liabilities plus equity. So that equal sign puts them on separate sides of the equation. And so that is kind of the driver between the differences in how we're going to account for increases and decreases. But with all that said, aside from knowing the underlying theory, if you can just start to familiarize yourself with the concept that the assets and liabilities, the net worth increases the same way and decreases the same as liabilities, but assets increase with the increase on the left versus right. And then that also comes into play with revenues. So revenues increase on the right, similar to liabilities, and then expenses increase on the left, similar to assets. So just something to keep in mind. It's something that we will deal with in one way or another through accounting work that we do all throughout the semester, but just start to familiarize yourself with that concept. So with all that said, let's start putting in our opening balances here. So as I mentioned, we're just going to go ahead and type in our totals here. So in order, if this is your first time ever in Excel, a couple just real quick things. I've already designed these spreadsheets, so a lot of the work there as far as setup is done. But there's different tabs that we can navigate through. So we're on the first problem here. And then there's cells, they call them, all throughout this Excel spreadsheet. So this cell would be B10, essentially, right? And this cell would be B11. This cell would be C10. It's really where the intersection of the columns and rows is the specific cell. And so these spreadsheets are really based on that fact that you can put information into specific cells, you can put formulas in, all those kind of things, and it really helps us with our accounting work. Okay, so to put numbers into your spreadsheet, then we're just going to click into the specific cell you want, and then type in the numbers basically. So 4,400 of cash. We're going to come down here to contents of home, 2,800. Automobile, 4,800. House, 287,900. Okay. And then on our liabilities, we've got unpaid accounts, 8,500. We've got a mortgage of 239,300. And finally, our net worth is 52,100. Okay. So now we've got all of our opening balances input into the opening balance places. And like I was talking about here previously, note that with the increases or decreases on specific sides, that also plays into these beginning balances, because not only do the assets and liabilities and net worth increase or decrease on separate on the left or the right side, but when we say we have an opening balance, so just what is the current balance, that we call that the normal balance also, that will be on the side that also increases it. So you could almost think of this as like opening or increasing side, opening or increasing, but we just put it as increase and keep it a little bit more simple. There's only really one time that something, where you put the opening balances, so it's not something that comes up over and over again when you're doing these problems, but it is something to keep in mind and understand when you're putting the opening balances in. Okay, so step one is complete. We've put in all our opening balances here. So next steps, we're going to account for the following transactions. Okay, and something to keep in mind here that we'll be working through this whole semester, and a key foundational concept in accounting, is the idea of the balance sheet and the income statement. And so the balance sheet tells us what is the balance at any given point in time. So in this instance, we're saying, we're going to arrive, these balances are as at July 1st. And when we do all our work, we're going to end up knowing what our balances were at July 31st. So you can kind of think of it in a way of like, if you were to check your bank balance at any given point in time, that would be what you'd have listed as your, on your balance sheet, your assets, your liabilities, etc. The income statement is actually going to show us activity over a period of time. So this is going to tell us, the balance sheet tells us, for example, at July 31st, on the specific day that I'm looking at my bank balance, for example, I have a certain amount. But the income statement will tell us, how did I get to that amount? over this time period that we're looking at, how did my revenues and cash flows in and out, and revenues and expenses in general, how did they fluctuate, or it's kind of almost like a roadmap, and the balance sheet tells us point A and point B, and then the income statement is basically the route that we got from one place to the next. Okay, so hopefully that you'll come to understand that a bit as we do all of our work over the semester. Okay, so with that said, let's account for the transactions here. So transaction number 1 says that we purchased a $1,600 high definition television using a credit card. So a couple important concepts or ideas here to understand. So we purchased a television. So the television, we have to first think about whether the television, is that going to be an asset, a liability? Is it a revenue or an expense? We need to categorize these concepts so we can accurately account for them. And let me touch briefly at this point on the definitions of revenues and expenses and how those things are going to differ from the concepts of assets and liabilities, essentially. So, as I think I mentioned earlier, assets are things that you own. Liabilities are amounts that you owe. And then revenues and expenses are, as I mentioned, kind of that path, that got you from one cash balance to the next. And I think these concepts are relatively understood, in day-to-day life. I think most of us have heard these words before: revenues, expenses. Income could be kind of another replacement, maybe, instead of revenue. I mean, we all have, personal expenses that we incur, etc. But really, when we're talking about this from an accounting perspective, we can think of revenues as, amounts that we earn by selling goods or providing services. So over the month ended July, or earned in this instance from other means as well. I think there's some problems here, or here it talks about in chapter, we earned $60. So any amounts that we earn will go as revenues. That's really the important concept there. The important word, I think, is what is earned. And when we talk about expenses, that's the cost of basically our life in this chapter. We're going to pivot to more of a business focus, but in chapter 1, when we're talking about personal finance, more personal accounting, in this instance, is really, like we can see here, food expense, telephone expense, utilities. So it's really kind of the expense that we incur and the amounts that we will either pay immediately or pay at some point that are cash outflows that we have to incur to keep ourselves alive, essentially. In a business context, we talk about it more from a perspective of incurring these expenses to generate these revenues, essentially. It's kind of a weird concept when we're thinking about this from a personal perspective, but we do all incur expenses in our day-to-day lives, not necessarily that we have to incur these to stay alive per se, but going to college is an expense, for example, and it's just the cash outflows that we will either paying immediately, like I said, or eventually will have to pay. So I mean, in a simplistic perspective, you can kind of think of revenues as money coming in and expenses as money coming out. And again, really important concept is that we can have an expense, but maybe the money hasn't gone out yet, but it would still be an expense if we incur a liability. Like, for example, when we buy a house, we're not necessarily, like in this instance, he didn't pay cash, so the money didn't necessarily all go out, but we've got a mortgage. So sometimes there's a liability associated with cash going out, and it's just a matter of us having to pay that with cash at a later date, like when you buy something with a credit card, like we see in problem number 1 here. Okay, so back to the problem now with that context. So we purchased a $1,600 television. So a television is something that we own. It's an asset, and so that's going to be in our contents of home section. And it tells us that we purchased this television using a credit card. And really quick, actually, just to circle back, I want to differentiate. So we bought, cash did go out, or sorry, cash did not go out. We incurred a liability to get this TV. But keep in mind, it's an important concept to differentiate between cash outflows for purchasing assets and cash outflows that would be expenses. So another way to think of expenses as well is cash outflows that you are never going to see again, essentially. Like the money is gone. This TV, we have an asset now, but if you're buying food and basically that money's, you can't, resell that food at some point in the future, right? You could potentially resell this TV. So it's you still own the TV. You're trading one asset, cash, for another asset, a TV, essentially. So that's an important distinction to understand the difference between expenses, cash outflows that lead to expenses, and cash outflows that lead to either increases in other assets or decreases in a liability. And we'll practice that over and over again. That's really kind of the basics of foundational accounting. Okay, so we had an increase to an asset for our TV purchase, and it says that we used a credit card, so we didn't have cash go down. Instead, we had an increase in our liability. So we're going to put that liability increase on the right side. We're going to put the TV increase on the left side. And when it comes to balancing, like I mentioned before, and making sure that our accounting equation is always in balance, we always want to make sure that our assets still equal our liabilities plus net worth after we're done accounting for any of these transactions. And as you can see, assets would be a plus on the asset side of the equation. And remember, equals liabilities plus net worth. And so the liabilities went up by $1,600. And so basically, I'll just write it out here, just to give you if we were to have this, as our equal sign. So here's our foundational equation. And like I just mentioned, if we had 1,600 go up under our asset side as a plus, and then we've got 1,600 go up under our liability side, you can see that equal sign still is accurate. Nothing happened to net worth here. And if we were to say 1,600 equals 1,600, that is a true mathematical statement, and we are still balanced. If you had 1,600 just on this left side, then you would be out of balance, right? Or if it was 1,500 here, you would be out of balance because 1,600 does not equal 1,500. So this is this idea of balancing that's very important in accounting. And so you can see with what we did that on both sides of the equation here, using our T accounts, we are in balance. Okay, let's look at transaction number 2. Here we paid a telephone bill of $640 for the month, again using a credit card. So this is a good problem where we're seeing that, again, a credit card was used, so an additional liability, an amount that we will owe, we will have to pay in the future, is increasing. But in the first instance, we bought an asset with an increase in our credit card liability. But here we're increasing our credit card liability to pay for a telephone expense. And so as you can see, we've increased our liability again, but now we'll come down to telephone expense and we'll record that on the increase side there. So sometimes, and maybe this is helpful to think of, paying for your telephone bill, it's already been incurred. That service was provided by the telephone company for the prior month, essentially. Or for the, it's already been incurred. It's not, you don't own that telephone expense like an asset. That doesn't really make any sense. It's more so they provided a service, you owe them money, and it's a cash outflow. Okay, so that's an expense. Let's look at number 3. Here we paid a credit card bill with cash for $3,300. So now we've been increasing our credit card bill in these first 2 transactions. Now we're going to decrease a liability. So the first thing to notice, we paid it with cash, so we're going to put the $3,300 on the decrease side. So cash started with $4,400. Now we're going to use $3,300 to pay our $300 to pay our credit card bill. So unpaid accounts will now decrease by $3,300 where it increased by $3,300 before. And that will bring down our balance of our bill to our credit card company that we owe at the end of the month once we total all the numbers up. Okay, so let's go on to number 4. We purchased $1,010 of groceries using cash. So we used cash here again. So cash is not a credit card. So cash is going to decrease by $1,010. And we're going to have that under food expense here. And again, we're going to hit our increase for expenses on the left side, decrease cash on the right side. We're remaining in balance as we go on the left and right. Number 5, we paid July's utilities of $1,100 with cash. So cash goes down by $1,100. And we've got utilities expense here. Okay. That was number 5. Okay, number 6, we made a principal payment of $1,100 for the mortgage. So here's a little terminology that we need to learn. When it comes to loans, and in this instance, a mortgage, which a mortgage is a loan that you incur when you're purchasing real estate, basically, property, a house, for example. And when we see the word principal, that's the amount that you borrowed, like the actual money that you borrowed through that loan. And to contrast that with the idea of interest. So typically when you make a payment, say for your mortgage, for your house payment, or for a car payment, for example, or something, if you have a car loan, a portion of that payment is going to go towards the principal. So that will reduce the outstanding balance that you owe to the lender. But a portion of that payment that you give to the lender will be for interest. So that's the amount that the lender charges you for borrowing the money. So let's just make it real, just to highlight this. Let's say you borrowed $10,000 to buy a car, for example. So you went to the bank and you borrowed $10,000. And let's say, I'm not going to worry about the actual, interest rates right now, but let's just for the sake of illustration. So you have now borrowed $10,000. You're going to make a payment, let's say, for $500 a month. Well, let me break that down. Let's say you make your first payment, and the total payment is $500. And let's say $400 of that payment goes to principal, and $100 of that payment is for interest, right? And so those total together to $500. So if that was your total payment, so then you borrowed the $10,000. You pay the bank $500. Only $400 of that goes to the principal. And so after you make this payment, you still owe $9,600 basically. And then the bank earns revenue, as from a business perspective, of $100, right? They didn't earn any money by you paying them this principal back because that was money they just lent you in the first place. So you're just repaying them their money, but then you're giving them some extra. You can almost think of it like rent, like you're paying them some interest because they've let you borrow that money, basically. And that's how banks and financial institutions earn interest revenue is by charging you for borrowing this money. So, and credit card companies, the same thing. So in this instance, we said it was completely a principal payment with no interest portion. And so in this example of number 6, there is no interest, just for purposes of this problem. Sometimes that happens. Sometimes it's all interest. And so here we said $1,100, and then the fact that it's a principal payment in total means that we're going to reduce the loan liability for the mortgage by the full amount, $1,100, instead of a portion like we would have seen there, and a portion of that payment going to interest expense on our side, or interest revenue for the bank, but it would be an interest expense for us if we were paying the mortgage and there was a portion of it that was an interest expense, not just principal. Okay, so that's number 6. Number 7, we deposited $4,700 of salary earned during the month. So here we have cash going up, so an increase. And we're going to record that as revenue. So we have an increase to revenue. And finally, we earned $60 of interest on a savings account. And so we're going to put that again under increases to revenue. And we're going to put the cash, going up essentially. So, and you could break these revenue accounts out like we did with expenses here. You might see salary revenue and then you might see interest revenue as 2 different T accounts. But for the purposes of this problem, we've just included those all under one area there. Okay, so now we've accounted for all of our transactions and we've gone through and done all that work. So now what we want to do is just to go through and kind of summarize everything and see if we balance, make sure we didn't make any mistakes, etc. So our total revenue, and let's do something first here. So let's summarize everything and then we'll do our totals up here. So I want to highlight something here. This is, so if we want to do formulas, because what we want to do is add together numbers, we want to subtract them, etc. So this is where Excel the shines here, is that we can do a formula. So you can go into this cell, you can type in equals sum with the parentheses and then highlight, so left click and drag down the cells that you want to summarize together there. And then you equal saying, give me the sum of J7 to J8, and that's J7 to J8. Right? So it just adds those together basically. And then the reason there's a second summation box here, and we'll look at that with the balance sheet accounts, is that if we have increases and decreases, we're going to total up the increases, total up the decreases, and then we're going to take the difference, and there's just going to be an ending balance, which should be on the increase side, and that will be our ending balance essentially. The increases less plus the opening less the decreases gives us our ending balance. But in the revenues and expenses, we only see activity on one side, unlike the balance sheet accounts. So really we can say equals this number. Just, it's a little bit redundant, but if we want to continue to have a total in both these summation cells, we can do that. Another way to do summations is this auto sum. So hopefully you all see that the same way I do. Sometimes on different computers it could be in a different spot, or if it's a Excel for Mac, it might look a little different. But there is an auto sum because this is such a common function. There's just this. If you saw how I did that, I put the cursor in the cell I want to do summations, and then I just click auto sum, and it immediately just comes down. Again, we only have one transaction in each of these, so it's a little redundant, and nothing in clothing expense, but that's just how it goes. Okay, so let's go ahead and finish once we've summed up our income statement accounts. So our total revenue then, and so here we're not going to do a summation, but we're just going to do an equals the total. So our total revenue is $4,760, and then we're going to do equals, and we do want to add up all our expenses here. So we're going to say equals, and you're going to left click on the cell here, I-24. Then you're going to put a plus sign, and then you can click into the next total you want to add, put another plus sign, click into the next total, just left clicking. And once you've got all the cells you want to add together, hit return, and you're going to be able to add up, that shows those adding together. And here's the formula bar. So if you want to go back, if you made a mistake or you need to add another account, or if you put 37 or something, and whoops, that was the wrong, you can't add a word. So then you can go back up here and say, whoops, I meant to, let me highlight this, and instead of that, I'm going to click here. So you can fix your formulas that way, essentially. Okay, now we've got our total revenues and expenses, and on our income statement, really what we're trying to get with the personal income statement is, did we have a surplus? Did our revenues exceed expenses? Or did we have a deficit where our expenses exceeded our revenue? We want a surplus, basically. And so to do that, we just take equals total revenues. So you can click that cell again, put a minus sign, and then click the cell for expenses, and we've got total surplus of $2,010 for the month. Okay, so now we've calculated our total surplus of $2,010. Now let's go through and basically do the same thing of just summing up our T accounts. And again, I'm just going to use my auto sum function because it's quicker just to go through. Sometimes it'll pick the whole, it'll when you push auto sum, it'll accurately grab all the accounts. In this instance here, let me just highlight that. So I clicked auto sum. It will stop. Excel kind of sums whatever's above if you're putting it this way until it sees blank cells. But in the instance of our T account, where we want to add everything on the left side, including the increase, we need to. This is not going to summarize all the stuff that we want. We want to get the 4,400 in there as well. So here, there's a couple ways to fix that issue. Either, as you can see, my cursor go over the right top hand corner, and it turns into kind of the arrows with that little diagonal bar. You could go there, hold down the left button on the mouse, and you can move the summation range. So we could just move it up to include the 4,400, and then we would have that accurate. Or if we wanted to just fix it in the formula, we could also come in here and just change this to B8, and that would add up through there. Okay, so now we've got total increases, including the beginning balance, opening balance of 9,160, and we've got total decreases in cash of 5,410. And so finally, this is where our second summation boxes come into play. We just take our total increases minus our total decreases, and we get 3,750. And so our ending cash balance is 3,750. I'm double checking myself here. I feel like I'm missing something. Oh, you know what? I had the 1,100 there. I think I might have missed. What did I miss? Okay, I think I missed the fact that they had two 1,100s. There was our mortgage payment and our utilities expense, and I just had the one there. So let me fix that. So this is maybe the mortgage payment, maybe they're the same thing, and then this decrease was the utilities expense. So if you saw that while I was going through, this is why we use these check figures, because it's very easy, especially in a manual system like this one or in Excel, to accidentally miss inputting one side of the transaction or the other. And we would catch that at the end of our work when our check figure did not balance anymore. Okay, so good illustration. And one thing to highlight too is the value of some of these formulas. You can see how we've got the summation formula here. And so it's really easy if you see a problem like that to just input your fix, and then this automatically updates because it's summing up everything in this range, which you just put a new thing in there, so automatically updated. This is already summing everything on this side. And this formula is automatically taking the difference between these two because we set it up right. And so we didn't have to do a lot of work, and the calculations just flowed through and everything updated. So that's kind of the power of Excel and using formulas, so on and so forth. Okay, so here we've got contents of home. There was no decreases, so kind of similar to what we saw in the income statement. It's kind of redundant, but we're going to bring that down just to complete both summations. There was no transactions to the automobile account, so we're going to just come down there with that. For the house, same thing. Okay, but now on the unpaid accounts side, we did have some increases and decreases. So again, remember on the cash side, we took our increases. You'd always take the bigger side minus the smaller side, and it should always lead you with a balance that's on the increase side, whether that's the increase side. You should have a balance on the right for an ending balance in liabilities, balance on the left for an ending balance on the assets. And then, so here we've got the bigger minus the smaller, F15 minus E15, 7440. So we're looking good. I'm just going to go through. I like using this auto sum function. Again, you could type this all out. It does the same thing, but it is a quick shortcut just to have that ability to push the button. Okay, so now we are arriving at the end of our work here. Let me pull this down. So we've summarized or completed all our T accounts, and now the final step is to take add all of our. So I'm just going to put equals and then plus signs here to add together all of our ending balances for assets. So I get 299,750. Our total life. So one thing you'll see me do in class as well, I want to highlight this, I guess, is you can do equal signs obviously and then add together. But another thing that you'll often see, and you'll see me do this, is you might see plus signs instead of an equal sign. Like you could do plus this, which is the same thing as equals this plus this. The reason why accountants often have a plus sign instead of an equals when they're doing kind of Excel work like this is that on the little part of where you're typing the numbers in, also known as like a 10 key, it'll have the 1, 2, 3, 4, 5, 6, 7, 8, 9, and then it's got maybe I can pull a picture of a 10 key just real quick. The idea really is that, here's a good example. Let me just do a little screenshot for you all to see. And I want to highlight this because it's kind of something that as you learn to be an accountant and you're working with a keyboard and you're getting better at typing numbers in, it will help you. So you can see this 10 key on your keyboard. There's no equal sign, but there's a plus sign right here. And so if you're kind of just laying your hand on this area and going really fast, you can just use the plus sign in place of the equals, and you don't have to be clicking off of the 10 key space with your hand. So it's just a little thing becoming quick with numbers on a keyboard basically. So anyway, so you'll see that sometimes. So as you can tell, I just did plus this and then hit enter, and it will automatically put that equal sign in there for you basically. So just little tips and tricks to make you better at Excel. Okay, so here we go. So total assets equals, and it should equal total liabilities plus net worth. Remember, that's our accounting equation. So the moment of truth here. Oh, one thing actually I forgot to do. So when we talk about net worth, this is basically our opening balance. So let me link to opening actually here, because net worth is a little different as opposed to just taking the ending balance of assets and liabilities. Because for net worth, we want to take the beginning balance plus the surplus, or if it was a deficit, it would be minus that deficit essentially. So our net worth has increased during this month by $2,010, ending us with $54,110. Okay, so here we are. Let's do one final summation to get the total of liabilities plus net worth. And woohoo! Look, we've got a match here. So total assets equal total liabilities plus net worth. Our balance, we are now balanced. That's our kind of our check figure, so we can check ourselves and make sure that we didn't make a mistake in terms of balancing, and we're good to go. So if I had made that mistake that I caught when I started, say, and I did not have this 1100 in here, let's just, for the sake of illustration, delete that out. Now you can see where we don't balance. Our assets don't equal our liabilities plus net worth, and that means that we messed up when we were putting our accounting in, right? And so that's like our check figure. If we get to the end of the problem and see this, that would be a highlight. That should be a red flag there that jumps out at you and says, "Whoa, we missed something," and that's where you go back through. And if you're new to Excel too, there's undo and redo buttons here, so those are important to understand if you're doing some work in Excel. And so here I undid my deletion just to put us back into balance, and we get to the end of the problem and we are good to go. So if you get to the end of a problem and you don't balance, it definitely happens sometimes to students, especially like on an exam or certain times like that. It is an issue. It does mean something's wrong, but don't break down. Stay calm and that's almost like one of the most valuable skills as an accountant, is to, one, be able to identify that something is out of whack, and then two, remain calm and develop the ability to go back through your work and find what you might have missed. So like I'll just give an example real quick of how, let's say if I didn't have this in here, one way you might approach this being out of balance, a quick one, is to take the difference between assets and liabilities and net worth and see that, oh, we're off by 1,100. And that would be a clue to go back and say, oh, we did have two transactions here that were 1,100. Let me look through and see, you might say, oh, here's an 1,100. Here's, two on the left side, but then only one on the right side when you look through. And that's, you might catch yourself and fix your error that way. You might go through and say, oh, okay, I found my error. Now I put that in. Okay, now we balance. So anyway, stay calm. It's not a race. Accounting is a process, and errors happen constantly. And really, our job as accountants is to be able to identify when they do happen, and then develop processes and be able to resolve those issues. That's really the skill set, to be resilient and maintain a well-functioning accounting system. So, all right, that was AP8B. I'm going to separate these into 3 different videos that work on each individual problem. This one I spent a little bit extra time on because we're just learning about Excel, and I'm hoping that you will be able to pick up some of those skills. And then in the next video, we'll work on AP14B, very similar, and we'll go a little bit faster and see if the skills that we just talked about in depth and all that context makes sense. And let's see if we can work through another problem. Okay, so I will see you in the next video. Thanks, everybody.